Good afternoon and welcome to the annual Dallas Regional Chamber Year Ahead event. My name is Dwayne Dankeschreider, Senior Vice President of Research and Innovation at the Dallas Regional Chamber. At the DRC, we work every day to ensure that the business community has the latest information about what is happening in our economy so you can make better decisions about the growth of your company. We are excited to bring you this conversation today. I think it's our best Year Ahead event ever. Of course, today's event and so much of what we do would not be possible without the generous support of our sponsors. Specifically, I want to thank our presenting sponsor, Polsinelli, our gold sponsor, OCC, our silver sponsor, Amerant Bank, our bronze sponsor, BKD, our VIP reception sponsor, presenting sponsor, Deloitte, and our VIP reception attendee sponsor, Simmons Bank. Thank you so much. Now I'd like to turn things over to Michael Pegues, who is with our presenting sponsor, Polsinelli. Michael is a shareholder and vice chair of the intellectual property litigation practice at Polsinelli. He was also recently appointed by Dallas Mayor Eric Johnson to the Board of Commissioners for DHA Housing Solutions for North Texas, formerly known as the Dallas Housing Authority. Michael, welcome.
Dwayne, thank you very much. Good afternoon, everyone. I'm Mike Pegues, and I'm an intellectual property shareholder, as David mentioned, at Polsinelli here in Dallas. I'm also the vice chair of our intellectual property litigation section. On behalf of Polsinelli, we are thrilled to once again be the presenting sponsor for the Dallas Regional Chamber's Year Ahead. In our Texas office of Polsinelli, we have more than 80 lawyers and in both Dallas and Houston, and we have grown 10 to 15-fold in the last 10 years and excited to be a part of the Texas economy. Our robust presence in Texas is strong, and we are committed to supporting and representing businesses ranging from entrepreneurs to middle market leaders in national organizations to some of Dallas's corporate headquarters across a wide range of industry sectors. We are pleased to be with you today. And today, we've got a remarkable lineup of economic leaders and, by the way, musicians. You'll find out about that later, that I'm anxious to hear from. Starting off, we have David Solomon and Stacey Cunningham in conversation with CNBC's Senior Economics Reporter, Steve Liesman. It is my honor to share with you a little bit about two of today's participants. Leading our conversation is Steve Liesman, the Senior Economics Reporter with CNBC, who will be moderating the fireside chat and is an Emmy-winning and Pulitzer Prize-winning journalist. Steve reports on all aspects of the economy, including the Federal Reserve and major economic indicators. He appears on the weekday show Squawk Box, as well as other CNBC programs throughout the day, and is a guitarist in a Grateful Dead band. So there's a little extra for you on Mr. Liesman. Now, for David Solomon, he is the chairman and CEO of Goldman Sachs, also known as DJ D Soul. Previously with Goldman Sachs, he was president and chief operating officer, and prior to that, he served as co-head of the investment banking division from 2006 to 2016. Before that at Goldman, David was global head of the financing group, which includes all capital markets and derivative products for the firm's corporate clients. He joined Goldman Sachs as a partner in 1999 and a world-renowned electronic music DJ, AKA DJ D Soul. Now, I'd like to turn it over to John Davidson, CEO of OCC, today's gold sponsor, to introduce our third speaker. John?
Well, thank you very much, Michael. OCC is proud to be the gold sponsor of this conversation. As the world's largest equity derivatives clearing organization, OCC ensures confidence in financial markets and in the broader economy by focusing on sound clearance, settlement, and risk management principles. We are the buyer to every seller and the seller to every buyer in the various US options markets. As guarantor, OCC ensures that the obligations of the contracts it clears are fulfilled. While our headquarters is in Chicago, we employ about 200 colleagues in the Cypress Waters location near Dallas, although currently they are all working from home in the Dallas metropolitan area. Let me introduce Stacey Cunningham. It is my pleasure to introduce Stacey. She is the 67th president of the New York Stock Exchange Group, which includes the New York Stock Exchange and a diverse range of equity and equity options exchanges. Those are one of OCC's participating exchanges. I had the pleasure of meeting with Stacey and her colleague Ivan Brown, who runs NYSE's options business, just 11 months ago in a conference room at 11 Wall Street in New York City. The walls of this particular conference room are hung with framed canceled stock certificates, one of which was a gold bond for U.S. Steel Corporation, endorsed by Lucy Carnegie, a niece of the company's founder. And that, in a nutshell, is what the franchise that Stacey leads has been about for the past 200 and change years. Public ownership and public trading of securities is the great financial equalizer, allowing people from all walks of life to have access to the tremendous growth and prosperity of the American economy, and indeed of economies around the world. We in the United States have the deepest and most liquid capital markets in the world, enabled by institutions like the New York Stock Exchange and supported by financial market infrastructures like OCC. Stacey is the first woman to lead the NYSE Group in its 228th year history, but to steal a note from our Vice President-elect, I'm confident she won't be the last. She has held prior roles at the NYSE as Chief Operating Officer, President of NYSE Governance Services, and served as Head of Sales and Relationship Management. Before rejoining NYSE, Stacey held several senior positions at NASDAQ. She began her career in financial services while getting a degree in industrial engineering at Lehigh University as a summer intern at the NYSE, and later as an employee on the trading floor, as well as for 8 years as a specialist on those floors. Please welcome David, Stacey, and Steve.
All right, can everybody hear me? Is everything good?
Sounds good.
Okay.
I can hear you.
Really pleased to be here and taking a request from the Dallas Chamber. I got a long history going back with Texas from my first job in 1987, covering things in Texas, to covering the energy business, to you can't cover the U.S. economy without knowing what's going on in Texas. Let me start right here with the news that's out there. David, this might have been two questions, but it's really one now, which is, when you think about the outlook, how do you process the two divergent big developments we've had, this vaccine news with a 90% cure rate and the resurgence of the virus to levels we haven't seen before?
So first, Steve, thank you. Thank you. I'm happy to be here with you, and I'm also Stacey. I'm happy to be here with you. I think it's very, very hard to balance them and come up with a clear and certain answer that everyone wants. I think people are craving more clarity right now, and consistently, as I've had the opportunity to speak publicly, I've talked about the fact that I still think the environment's incredibly uncertain. Obviously, the vaccine news is a real positive in the progression of our moving toward something that will help us move past the pandemic in a much more significant way. It was very, very encouraging, but it's not absolute in terms of plotting the absolute course over the coming months. At the same point in time, the resurgence is concerning. The virus is everywhere. It's around. Obviously, as it's around, we watch very closely hospitalization and death rates. I think it's having an impact on behaviors, whether it's governors broadly trying to restrict activities in some way, shape, or form, or just human nature. I see it just talking to people at Goldman Sachs and thinking about our return to office. There's no question it's evolving as people are dealing with the newfound sense of how the virus is around. So at a high level, what I'd say, it's still very uncertain. It's unclear we're going to get past this. But if you're looking for real clarity over the course of the next 3, 4, 5 months, I think it's going to be a very uncertain and bumpy period.
Stacey, same question to you. How do you process these two divergent streams going on right now?
Yeah, I think that there's the news that's being processed by the market this week around the election as well as around the vaccine. They're not unrelated, because the success of the vaccine is going to be tied to how do we perform across the country in delivering it and actually getting it into people's arms. So we still have several months. And I think the initial market reaction was because people were looking for hope, right? And this was a real sign of hope that there is an end, but it's not immediate. And so we really have a lot of work to do to get there so that we can get the benefit. And many businesses are buying themselves time and trying to figure out how they can trim costs, how they can reduce all the expenses that they have to get to a point when the economy can really recover, because we've been able to tackle the virus and really start to get to a point. But we have 6 months before we're in a place where we really get the benefit of the vaccine and start to see that play out. So, you know, I think it's optimistic that we've seen that. I expect we're going to see the markets move in both directions over the course of the next several months as we start to figure out how effectively is the administration going to handle delivering the vaccine and all the steps we need to take. I think we talk a lot about the vaccine. It's a great thing because it's a wonderful development, and we can't possibly overemphasize the achievement from the pharmaceutical companies and the speed that they've come to market with this vaccine. I mean, it's really astounding, and that's encouraging. But it's not all about the vaccine, because like I said, we have 6 months. So how are we protecting ourselves in that period of time? And certainly the therapeutics and drugs to treat COVID-19 are a big part of that too.
Stacey, let me stick with you. And this is a little bit of a personal anecdote here, which is that this resurgence in the virus has caused me to rethink my thinking about when things were going to open up and things that I personally could do. I've got a band I want to get back performing with, and I just have in my brain moved that ahead by 6 months. When it comes to the New York Stock Exchange, you made the bold call, of course, of going totally electronic. Have you in the past several weeks expanded that horizon for when you might get back to normal?
We are back in the office. So when we closed the trading floor in March, and I will say that is one of the hardest decisions I've had to make when you're choosing between people's livelihoods and people's safeties, because the traders on the floor don't work for the New York Stock Exchange. Many of them are small businesses. So by closing the floor, we were shutting down their businesses. And at that point in time, it was unclear what was happening. But we learned a lot about the virus over the subsequent 2 months. So following that closure, we were able to reopen Memorial Day. So we've been reopened since May, but we put in protections in place so that we can limit the risk inside the New York Stock Exchange. We worked with advisors. Dr. Scott Gottlieb has been an advisor for us as we reopen the trading floor. You know, he's a friend of CNBC, and we've certainly heard a lot of great advice from him along the way. We have roughly 400 people coming into the trading floor each and every day, and we have not had an issue, but we wear masks, we have sanitizer everywhere, we're social distancing. And so while there were a couple of cases that were screened, and we know that people had tested positive along the way, we don't have any evidence of any spread within the building because of all those protections that we put in place. I think that's an important message for the businesses that are out there and trying to get the economy reopened, is we can do things safely. We just need to think about the risk reward. You know, what benefit are we getting from taking certain actions? What things can we limit and slow down until we're in a safer place? But then how do we actually, for the things that we want to keep operating, how do we do that safely so we can de-risk things? And that's how we've been approaching it. We scaled up since we reopened. So we're at roughly half the number of people on the floor that there would normally be, but we're trading all of the stocks that, all of the stocks are traded on the floor. I don't see us scaling up until there's a vaccine further from where we are today.
Okay. David, I want to throw the same question to you. I don't know how many people you've brought back or have back right now, but what in the last several weeks has your thinking changed at all about getting back to normal?
So my thinking hasn't changed, but I certainly think that the people who work for Goldman Sachs, their thinking's evolving, and the experience that people have is very personal based on how they react to the current news or the current situation. But just to put our experience a little bit in context, we operate obviously all over the world, and it's very, very different what's being experienced right now all over the world. I spoke to some of my partners in Asia this morning, and in Asia, in Hong Kong, for example, basically we're back in office, and they would describe that they're basically operating pretty darn close to what would be called normal. Everything in life is basically functioning. Do people wear masks as they move around? Yes, a little bit, but we're basically in office and operating in the things that people do outside of office, things that you and I would talk about, would like to do. People are back at it in some way. In Europe, we had pushed ahead, and probably on the continent, we were 50% in office. We were about 35% in office in London, but obviously that's backed off over the course of the last 4 weeks. In the UK, there's a work from home order that's obviously had a significant impact on where we are there. So there it's adjusted. In New York, we've had about 20% of our people in consistently since Labor Day. Basically, we opened up in June. We opened up with all the same protocols Stacey's talking about. We wear masks, we socially distant, we have active testing going on for people who are in the office. And we too have not, here in New York, experienced any significant issue or any significant spread. We can operate safely under the protocols, I believe. And so we've operated with about 2,000 people, which is 20% of our New York workforce in the office. My guess is, given what's going on now, given we're approaching the holidays, while we still feel very comfortable that we can continue to operate safely, I think human behavior around this time of year is naturally going to change a little bit, and our numbers probably will look differently. But we continue to put our people first and their safety first, but at the same point, getting our people to interact is important culturally for us to execute on our business. I don't think we'll get to a level that's different than where we've been operating until we get further out, just as Stacey said, and we get to a vaccine or a better place. But I would expect over the coming months, we'll operate in the same construct, and the number of people that choose to come in will go up and down a little bit depending on what circumstances we're dealt.
All right, David, I want to write this down. What would you estimate right now is the date of your first live performance?
The upside would be next summer.
Next summer.
The downside scenario would be the end of the year into the early next year. But Steve, if you'd like a personal performance, you and I can get together socially distant, and I would do a personal live performance for you.
That works.
I'll be the audience. I'll cheer for you.
The timing up. Stacey, you can come too, because we could have 3 people in the room.
Yeah, that's all. If there's 50 people in the room and 48 leave, there's still enough for me to keep playing. Let me stick with you, David. And folks, I'm going to get off the coronavirus in just a second, but there's one more thing, one more question I want to ask, which I think is important. David, there's a lot of talk about what remains from how we've adjusted to coronavirus and what doesn't remain. And it's kind of like buy Zoom or sell office REITs, kind of question when it comes to an investment standpoint. Has Goldman learned over time that there's more that it and its employees can do remotely, and will that to some extent continue after the virus passes?
I think we're all learning. We're on a journey. When I woke up on January 1st, I certainly didn't expect 2020 to put us on this particular journey, but we're all on a journey. And so we're all constantly learning. There's no question about that. I've said repeatedly over the last 8 or 9 months that I think a pandemic like this, or a crisis, accelerates and amplifies some trends, but I don't think it fundamentally creates new paradigms. And so we were on a journey already to more flexibility in work, more remote communication. I think that the pandemic has amplified and accelerated the pace at which it's been adopted, and also avenues or channels where it's been adopted. But when it comes to our business, and look, it's going to be different for different businesses, human interaction, the apprenticeship nature of the business, or professional services firm at the end of the day for a lot of our business, I don't think when we get to the other side and you look at Goldman Sachs, it'll be that different than it was on January 1st. Pre-COVID, we had on any given day 30% of our people working remotely anyway, because people travel, they move around. There's always been good flexibility in our culture to do that. I think what we're learning is there are lots of places where we can do things more efficiently. Because as you spread people out, you start to really think about who do you need and what do you need to bring together to really get something done with the level of excellence you want to get it done. And so I think you'll see staffing changes across all sorts of businesses. I actually think that's one of the headwinds we're going to have from an economic perspective going forward, is businesses are going to see, based on what they've learned, that there are efficiencies. And when we get past this, it'll be easier to make those adjustments than it's been during the crisis. But I think broadly speaking, the world, moves in a direction, and we're moving in a direction, but I don't think it's getting turned upside down. And I watch I watch your shows, every morning. I'm working out and watching, and I know there's a big discussion about pick this, pick that. And of course, every day, the market goes up and down and things choose. I'm not good at picking stocks or choosing what's the right valuation. Good companies will do well over time. And the short-term flows, I try to stay out of that and try to take more of a medium or long-term view. Long-term view, the changes aren't going to be that dramatic.
Steve, I would share the lens that I see that through because, I talked to so many CEOs of different companies, and back in April, the message was universal, consistent. Everyone was so excited by how productive their teams were when they were suddenly remote. Nobody expected that their teams could operate as efficiently and effectively as they did. Fast forward, the feedback isn't universal, right? So now people are thinking, for our business, we want people back in the office, or others are rethinking their workforce. Are they going to separate certain functions and make those remote permanently? Or will it be more flexible where some days a week people are coming in, but just not quite as often? That's definitely diverging. There are some trends that seem to be consistent in some sectors, but not across the board there even tech companies are thinking about it differently. So you're starting to really see people asking themselves questions, what worked? I think in April, people were really productive because we were in a crisis and people rise to the challenge of a crisis. And frankly, there was nothing else to go do. So there wasn't a lot of distractions. But now over the long term, I think you're going to see mixed results. And I agree with David. I think a lot of businesses will look very similar, but there are some that are really going to change the way they have their staff, their teams coming into the office or not.
But Stacey, the question.
Steve, I just want to add one thing, if you don't mind, on this. Because Stacey, what she said prompted it. As I talk to CEOs today in November, and just like Stacey, we both talk to a lot of people. There are very few CEOs privately that are telling me that in this environment, they think productivity is up. Almost all of them are telling me now they think productivity is down.
Yeah, they feel it now.
One of the things that's gauging my forward view is now that we've gotten into it, and everything Stacey said is right. It felt different at the height of the crisis when we were starting. But now that everybody's had a chance to digest, privately, there aren't a lot of people saying this is really productive. In fact, the opposite, productivity is constrained.
Fascinating. I would just add that I have come to realize how much I hate taking the shuttle to Washington, what a psychic and productivity drain that is on me. And I'll go back to that when I have to, but I don't miss it one bit. But Stacey, the question really comes to you. You've been able to do your business substantially electronically. Does that mean there needs to be a move? Is that a more productive format?
Yeah, so it's really interesting. And this is not an experiment I ever would have chosen to run, but we had the opportunity to look at the data for the 8 weeks that we were closed. We were closed from March 20th through Memorial Day. And during that period of time, the exchange was operating completely electronically. We have a different market model where we have every stock that's listed on the New York Stock Exchange, every company has an assigned market maker. So those market makers still had the same obligations that they have when the floor is open, but they met them entirely algorithmically instead of also having the benefit of the human being that has that responsibility at those firms. So the firms still had to meet their obligations, but the people weren't coming into the trading floor. So while we know our stocks trade with less volatility, we don't know how much of that outperformance comes from the fact that there is an accountable person who a human being, or the fact that there is a higher standard that we put on those market making firms that have obligations to meet. So we got to actually study it. And it was really interesting. And there are a few academics that actually took the opportunity to run their own studies and look at the data. And what we saw was our stocks traded with less volatility than other exchanges that don't have that model, but not as good as we normally traded when the floor was open. So we saw a reduction in trading volume around, especially the closing auction, which has become a really important liquidity event, especially given the rise of passive investing. And so we've seen, what we saw was there is value in having that human judgment. So we definitely are committed to it. One day in late March, it was the last day before we closed the floor. President Trump announced at 3:59 that he was going to have the oil reserves filled. And so a lot of the energy stocks took off with massive buy imbalances right as the market was about to close. And so the human judgment kicked in and people said, wait a minute, there would be sellers if the gates were still open. And so we delayed the closing auction, opened the gates, and those stocks closed in line. Having that ability to apply human judgment leads to more investor protection, greater investor protection. So we're committed to that.
That observation could save the whole human race. I mean, the humans are actually. David, did you want to comment on that? Because I know you're obviously involved in that issue. So give us your thoughts on it.
I mean, I think Stacey said it well. I don't have the data that Stacey has, on a day-to-day or real-time basis, but, I think this has been an interesting experiment and really kind of looking at human interaction and trying to think about what are the benefits, where can you be, efficient away from it. And I think broadly speaking, I agree that we need to come out of this and get back to a little bit more of what we've been doing. We'll see, more productivity because of that.
Fascinating. Stacey, I want to go back to you, and I want to turn to the elections here. And I want to start off with a very specific issue, which is China has been a big source of IPOs and capital and all sorts of things for the New York Stock Exchange, for the broader American capital markets. And yet China is a massive political issue right now. Do you expect any particular changes with the incoming administration when it comes to the attitude, relationship, and general restrictions that have to do with China?
I think we're still going to see a focus on making sure that we have the right level of investor protections across our markets. So one of the issues that has come up with respect to China in particular is that it's one of the countries that doesn't have the same level of audit oversight from US agencies. And so the PCAOB audits the auditors and gets to see that visibility, and they don't have that access with China. So that's one of the issues that's been talked about as a concern with respect to Chinese listings. I am encouraged and I'm hopeful that we can come to a solution where we can provide that level of oversight without denying investors, US investors in particular, access to those opportunities. Because what makes the US markets the deepest and most liquid is we really effectively, I would argue better than anywhere else, balance the benefits of investor access and investor protections. So creating those opportunities is really critical. And the reason why investors the markets are so deep is because we do have the highest level of standards. So that is an important issue. We want to make sure that we're addressing some of the gaps that might exist, but we don't want to deny investors from opportunities from other countries, because frankly, they will find another home and they'll list somewhere else. The companies will still become public companies. They'll still attract investment, and they'll just do it outside of the US. So I'm hopeful that we can solve that solution. I don't think it's a partisan issue. I think we'll still have these debates despite a shift in the administration. But there is some ongoing dialogue that'll be constructive, and hopeful we can find a resolution.
I want to stick with you on that, just with a follow-up, Stacey. Is there something that you'd be looking for differently, to be done differently by the incoming administration?
You mean specifically with respect to China on this? Well, I would be hopeful that we can find cooperation between the SEC and the Chinese regulators on a solution that provides the level of investor protections that US investors demand.
David, I want to turn to you, your broad reaction to the election, and answer it however you want, but one way you might do so is in relation to the outlook for capital markets and potential changes in taxation and other regulatory issues that are critical to the stock market.
So I think that the election result is a result that delivers a more balanced outcome as we think about policy going forward over the course of the next couple of years than might have been expected, pre-election. So if you were listening to the polls, the pundits, they were expecting more of this, quote, blue wave, which would have potentially led to not just a change in administration, but also a change in the Senate and maybe a strengthening or at least a consistency of the position that the Democrats had in Congress. And what we got instead is we got a change of administration. We'll know the result with respect to the Senate on January 5th, but at the moment, if the Democrats won both runoffs, we'd be at 50-50. Obviously, if the Republicans won both, we'd be at 52-48. And the Democrats lost seats in the House. And so there's complicated messages when you stand up at a high level and really think about this. But I think the electorate said that it wants a change in the administration. And so it voted for a change in the administration. And the electorate also voted, which was unusual, for balance or division in government to try to not let a set of the policies go, more directionally in one area. Now, interestingly, from a market perspective, and you guys talked about this, the thoughts of a blue wave in the short term led to people think there'd be massive fiscal policy, and fiscal policy would be very, very good for asset prices, and markets in the short term. Now, obviously, we don't see as aggressive a fiscal policy move forward, but a lot of the counterbalances that would have come later in terms of significant changes to tax policy, more stringent changes to regulation, it seems like those are harder. They're going to be more balanced at this point in time. And that's actually pretty constructive for markets too. So I think we kind of got to the same place, a relatively short-term constructive outlook for markets, but with different outcome than I think people expected. And so I think given where we are, ambitious policy changes are certainly going to be much more difficult if this, turns out to wind up when it's all said and done in January, the way it appears to be headed.
David, I want to just make a point and have you react to it, which is that everybody says that, gridlock is good. I think that misses something in that, no policy is better than bad policy, but no policy isn't better than good policy, right? I mean, there's real issues that are out there to be figured out and legislated and all kinds of stuff. What is it that you would like to see a Biden administration and a Republican Senate and Democratic House get together to do, even though that question on its face seems like it's almost idiotic?
Well, I appreciate the question. I'd absolutely agree with you that no policy doesn't mean good policy, and gridlock could be good or bad. I'm hopeful after a period of time, and by the way, this is not just one administration, we've been moving over multiple administrations toward a direction of more divisiveness in our policymaking in Washington. And it would be nice if we could find a way with a new administration and a new Congress where there is more balance to actually have an opportunity to work on some policy that might move us forward. And I know that's not always easy, and it might be, as you say, overly ambitious. But, thinking back, I think back, in my lifetime to times when people on both sides of the aisle really were reaching across and trying to find ways to make policy. I'm not going to offer a view as to whether that will or it won't happen, but I will certainly leave the audience with a hopeful view that it's my hope that maybe there's an opportunity here to move back in that direction. Maybe not, but I'd be hopeful that there might be a chance.
Yeah, Steve, I want to add to that for a second, because I agree that no policy is not as good policy. You know what I mean? That good policy is better. I think we're less divided than we seem. I think we seem as a country very, very divided right now. But I think part of that is because we have allowed the parties to be so extreme. And I think that's why people are looking for balance, because a lot of Americans don't want it to be one end of the spectrum or the other, and they're looking for something more in the middle. And that's why I found the most encouraging aspect of the election this year was the turnout, because we do need to use our voices so that we're putting candidates in place that we feel like represent sound policy that isn't necessarily so polarizing. So that's what I'd want to see this administration do, is focus on how do we come to some middle ground, and that will set us up to looking for candidates that we think we can get behind.
Are there any specific priorities from your business standpoint that you'd like to see resolved when it comes things like healthcare? Would that be something that would be useful for politicians in Washington to resolve instead of fighting about year after year?
I think there are a lot of issues that are important to both companies and investors right now. So if you're asking from the NYC's perspective, certainly ESG is an area of focus for so many. But we want to make sure we can handle those things in an appropriate way. Some of the challenges that are put forward is through legislation or regulation, we put a lot of standards on public companies. And one of the things that I get concerned about is just the divide between public and private. We've talked about the access to opportunities, and that's important and only valuable if everyone has that access. So I want to make sure that we are not restricting, putting such onerous standards on public companies that don't exist on private companies, so that companies just choose to stay private as long as they possibly can. Because the outcome is, and it has been, frankly, that they grow really quickly in the private markets until they're really, really big. And then they come out to the public markets and there's less growth. And that means there's less opportunity for the average investor. So as we think about policies that are well-intended, we should make sure that they're also balanced so that we're not encouraging behavior that ends up hurting the everyday investor.
David, you want to chime in on that? That's a really interesting point of view, which is how can it be changed? How can the regulatory policy be changed to encourage companies to come forward and be public more quickly? And is it indeed regulatory policy that keeps companies in the private sector private?
I don't know that it's, I wouldn't espouse that it's regulatory policy. But capital markets evolve, and we've been on a journey with capital markets, and the access to capital has evolved. If you go back and you think about historically, the venture capital community was a small group of organizations that took money from the wealthiest people in the country to basically seed new companies.
Right.
And as soon as they got going, there was no other place to go get capital other than the public market, especially for technology companies, because banks weren't lenders to technology companies. And so those growthy companies, especially in the technology space, turned to the public markets. As the world's progressed, private capital formation exists in all different forms, and private capital formation is very, very robust. The standards of disclosure and the obligation around private capital formation are different, although getting closer to public securities, but there still are differences. And there's a big difference in running a private company with respect to quarter-on-quarter performance and the transparency of your quarter-to-quarter performance as you're trying to make longer-term strategic investments. And so I think this is a convergence of not just policy but practice. When you think about quarterly earnings reporting, when you think about the way information transmits in a much more transparent world, it is very, very hard to run a public company and make longer term investments that might not pay off for a long time. You have to have a lot of conviction, or you have to be in a position where you're operating from real strength. And so I think over time, we can be thoughtful about how we can evolve either policy or practice to really reward long-term investments, long-term sustainability in businesses and what they're trying to accomplish, and try to take a little bit of emphasis off the short term. But that's a challenge. And as you know, it's not an easy thing to get right.
Stacey, do you want to follow up on that?
I do. I mean, I think I agree with David. And the access to capital used to be the primary driver for companies going public, and it's not anymore because they have choices and they have access to a tremendous amount of private capital. So what used to be secondary and tertiary reasons for going public, things like having liquidity for early investors, or really importantly for their employees. For many of these companies have been paying their employees in equity, and they want to have access to monetize that, or currency to engage in M&A, or just the credibility and visibility of a public offering is helpful for many of those companies. That's what's triggering them to go public today, less needing to raise money because they have access to money in other ways. So we just have to recognize that that's the change. So as we're looking at introducing disclosures, I mean, David's absolutely right. There's much more disclosure and governance and all those things in the public markets, which give investors the better visibility to make informed decisions. But it's easier for a big company to handle dealing with all those disclosures. So the more that we put on companies, they're just saying, like, let me wait until I have to go public because I don't need the public markets for money. Now, 2020 really changed that narrative a lot. We saw in the spring that the companies were tapping into the public markets to raise money when their businesses were suddenly impacted by the pandemic. And we saw massive follow-on offerings happening in the spring. And many of those private companies that had been private for a long time suddenly were paying a lot more money to raise money. And so, it was costing them a lot more. The cost of capital had changed dramatically. Sure. So we have seen, it's been part of the trigger in seeing so many companies coming public right now this year. I mean, we had a record September followed by a record October for IPOs. Right. And a lot of that has to do with not just how IPOs were being received in the market, but just the fact that people are concerned about the long-term dynamics of the private markets and having that access to capital during all conditions.
David, Stacey mentioned ESG, and I'll just tell you that I'm on the board of directors of Riverkeeper, which is involved in helping keep the Hudson River clean and protecting drinking water for the 9 million people who live in the New York area. There's my commercial real quickly. And I'm the kind of pro-business guy on the board. And I say, look, judged by my view of business, they seem more serious about these sort of things than I've almost ever seen in the past. But I sit on the board with a bunch of people who are very, very skeptical about some of the things I'm seeing about environment, sustainability, governance, all of those things. Give me an argument to bring back to the board there for why it seems to me like it's more serious than it really is.
Well, the reason it's more serious is the big stewards of capital in the world are very, very focused on it. And the big stewards of capital are really bringing into the lens of how they want to allocate capital in the decade that's going forward. They're considering ESG, but sustainability broadly. I think about sustainability as both the environment, but also sustainable growth for our society. And if you're talking to big pension plans, if you're talking to sovereign wealth funds, if you're talking to big institutional capital allocators, people that are allocating capital are actually putting in place the parameters to judge whether or not companies are more broadly contributing. And if capital allocators start to use, that framework in some way to allocate capital, it creates more real traction in the context of the focus coming from business broadly. And I think there's been a change. It's a journey like anything else. It's more accelerated in Europe than it is in the United States, although it's moving in the United States. I think the pandemic amplified it or accelerated it. To wake up in this country and to think that we did not have the necessary healthcare reserve on a variety of fronts with respect to PP&E to make our society sustainable here, that's unacceptable. And so I think that for a variety of reasons, this will follow the big capital allocators in the world. And the big capital allocators in the world are more focused. That's going to make businesses more focused. And that creates a virtuous cycle that I think we're early in the stage, but will continue.
Let me follow up. I want to give Stacey a chance to comment, as I know she has some thoughts on it as well. But David, is there any sense at all of the increase of the amount of capital that is demanding more from companies when it comes to these issues?
Absolutely. There's capital that's being raised that's dedicated, but also as you talk to people that are deploying capital institutionally, they care more about this. They're asking more about it. They're holding companies to a standard of trying to explain directionally where they're going over time with respect to their contribution, both to the environment, but a more sustainable society for all of us. So there's a balance in all of this. Of course, if you're running a big public company, you have an obligation to deliver for your shareholders, but there's no company that's going to deliver for shareholders over time if they're not taking care of a whole variety of stakeholders that we all have to deal with, our employees, the communities we operate in. There's no God-given right to operate your business in any community that you operate in. If you're not constructive and supportive of those communities, you can lose the privilege to operate. And so I think this is accelerating. It will be with balance. It's going to be a transition, but I hear it from clients every day. Every corporate client that we deal with wants to talk about how they're transitioning their business in the next decade, both to continue to drive great shareholder returns, but to make sure that they are contributing, more broadly to a broader array of stakeholders. And I personally think that's something that's going to continue to escalate as we move forward during the 2020s.
Stacey, you're on the front end of this. Tell us what you're seeing.
Yeah, there's a report that comes out every other year that measures the sustainability investment, and there's the last report was covered 2016 through 2018. $31 trillion of professionally managed funds are invested in ESG initiatives, and that's 14 of it is from Europe and 12 is the US. So the vast majority, a significant amount of it, but it's $1 in every $2 in Europe and $1 in every $4 in the US. And I expect when that 2020 report comes out, which we're expecting soon, you're going to see it continue to increase, because from 2016 to 18, it was up over 35% already over that period of time. And as David says, it's just continuing to accelerate in the US, while it lagged Europe a little bit, is certainly catching up. That stakeholder mentality exists already. I think a lot of companies are trying to figure out how to tell their ESG stories. I've talked to many CEOs who, while they hadn't yet been getting pressure from investors to focus on ESG and sustainability and climate, their employees are demanding it of them. So they've already been focused on it and they've already been doing it. And again, 2020, I think accelerated a number of things, and it also highlighted behavior. What we saw in the spring was companies not worried about their quarterly reports, but their quarterly earnings, but really focusing on how they could be part of the solution. When you see manufacturing companies completely changing their production lines to create ventilators and PPE, I mean, that's a stakeholder mentality. When across our 2,200 listed companies, we saw almost all of them looking for ways to become part of the solution and really dive in, and setting aside what their normal day-to-day looks like to do that. that's really what the underlying sense of ESG is how do we make a difference in the world and help protect the world. We just need to make sure that we can give them the right tools. So we do a lot of it around data, because a lot of companies are trying to figure out how they stack up with respect to rankings and ratings, which become the mechanism that investors use to determine how they want to allocate dollars to reward the behavior that they're looking for. So we collect 500 different criteria around ESG so that companies can actually see it, and then we'll echo it back to them so they can see how they stack up against their peers. And that's a stage that they're in right now, is trying to figure out what should they be disclosing? What are their peers disclosing? It's not one size fits all. Different sectors have different elements of that make more sense.
Here's a simple statistic, Steve, that just puts a fine point on it.
Right.
I believe this year, ESG funds globally have taken in $120 billion globally year to date. All other equity funds have had $125 billion of outflows. It's anecdotal. There are obviously different reasons for broad equity fund outflows, but globally, ESG funds $120 billion of inflows this year. So that's real. That's a real capital allocation in a direction.
Let me, I just got the 10-minute warning here, so I'm gonna try to pick 10 minutes to me is like 8 television eternities, but let me just see if we can get things up. First of all, a quick throwaway line here. Stacey, you did on one day, $330 billion messages, and you're able to make that happen, and we can't count 140 million votes in 2 weeks, and you did 330. You get to work on the other side there. Let me just throw that out there. I have some other things for you to do. When I was growing up, Stacey, SPAC meant the Sarasota Performing Arts Center, where we went to see the Grateful Dead play. But SPAC means something entirely different now. Can you help us out in understanding what is a SPAC and why is it the hottest thing since, I don't know, whatever? What's going on with SPAC? It's a big source of growth now.
Yeah, I think SPACs are really reflective of the shift in the capital markets. There's been a lot of innovation in the capital markets, and we talk about that access to capital not being always the primary driver. Although with SPACs, that's an advantage. Companies are choosing how they want to go public. They can do an IPO, they can do a direct listing, or they can leverage a SPAC. What a SPAC does is it raises money, and sponsors come out, they raise money, they go public without a business yet, without an operating business yet. They identify an operating business to acquire. And then at the time of that business combination, that's how they become a public company. Each one of these different paths to public, though, have really provide their own pros and cons. And so companies are choosing what makes sense. SPACs give a little bit more control because you're negotiating with a counterparty as part of a deal versus waiting to see what the market might, how the market might value. It's a little bit faster to come to market because you're not doing the same level and the same type of roadshow. It's just faster to get out to market. So that's another advantage. Investors have the ability to vote or not vote on the deal as it gets, the combination is announced. But alternatively, when you look at a direct listing, that's about cost of capital. So companies that are choosing that path are looking to go public without having to, let the market price they're offering. And the traditional IPO provides the value of, the banks and David's team bringing people out and actually helping them underwriting the offering, providing that, assuming that risk as part of it. I think you're going to see companies choosing all of them. I think one of the interesting elements is, Goldman would help you on any of them, and has been part and an active player.
Let me interrupt. David, quick comment on this. I hear blank check and see new abbreviations in the financial world, I get nervous. Why shouldn't I be nervous about this?
Well, I think you should be nervous.
Okay.
Because like anything else, when you innovate in capital markets, there are things that go right, and then there are things that go wrong. This is an innovation. It's a different form of capital raising. Everything Stacey said is right. I think one of the things that we have to be nervous about is we're bringing companies to the public market in a different way, and there's a different vetting process for how those companies get into the market. And some of those companies will work and they'll be terrific public companies, but some might not. And when investors invest in things and they lose money, there's consequence in the public markets. And so, I think that SPACs are here to stay. I think it's a really good innovation. But at the same point, I think that we'll continue to see an evolution in either the guardrails or the rules, the road. Stacey was highlighting that when a company goes public in a formal IPO process, they go out and do a roadshow. besides the fact that a roadshow takes time, roadshow also forces that company to stand up in front of very, very sophisticated people repeatedly and prove itself. That is a different process than being backed into a public company through an M&A transaction and then proving yourself over time. It doesn't mean both processes, can't work and be effective. So this is innovation. I think the rules and the incentives and the economics will change. The incentives are interesting. If you have a SPAC and it's about to be expired and you're the sponsor, you're incented to pay as much as you can pay to get something in it, as opposed to giving the money back. If you're the seller, you're incented to get as much as the sponsor will pay. So there are places where the incentives aren't perfect, and I think those are things we should be looking at. I think they're things we should be thinking about, and I think over time there'll be things that both the market process and potentially even regulators will have to opine in some way as to whether the process is perfect or not.
Sure. All right, guys. Now we're, as Jim Cramer would say, into the lightning round here, because we're up against the heart of it. David, you're expanding into Texas these days. What are you doing in Texas? And if you could, a very quick summary of your outlook on the energy business.
Well, on Texas, Texas and Dallas in particular is a uniquely attractive place. And we've been in Dallas for 50 years. But there's no question that as we develop and we build new businesses, we're finding that there are different places around the United States, or candidly around the world, depending on where we're operating, that can be good locations to attract the talent and to operate different kinds of businesses. So we're always going to have a big base in New York, and there are certain things that are very rooted in New York. But we've started, for example, a transaction banking business, which is more of a digital treasury function for companies large and small. And when we think about a location to locate that doesn't need to be in New York. In fact, most of the people that are in that business operate that business in other places. And so we think about Dallas, Texas, potentially as a place where, as we're innovating and building other platform businesses, it's a good location for us to continue to grow our presence. And so Dallas is one of a number of places around the United States where we have pretty big investment. And, my guess is that'll continue to grow over the next decade.
Go ahead, Stacey.
Okay, so a fun fact, we have more companies listed on the New York Stock Exchange from Texas than any other state in the union. And I think that says a lot, right? It's more than New York. It eked out New York along the way. But that says a lot about the way that people can get business done in Texas, right? So certainly
one of the things that I've had to cover over the years, and it's been an interesting story watching Texas develop from this economy that everybody thought was all about energy. They thought it was more about energy than it really ever was, but it's become this really dynamic state that's so fascinating to watch and to cover. Stacey, I want to turn to you. One of the big things that you're involved with is greater inclusion of women on the board, both you and David as well. What can you tell me about what's happening there? And again, I'm up against, these people are very angry over there at the Dallas Chamber. They want to get quickly hungry or whatever they got to do. No, they're not.
Companies need diversity at the top to be able to run diverse organizations. And so getting board diversity is really critical. We tap into our network of all the companies listed on the New York Stock Exchange. David, we are grateful for the fact that he sits on our advisory council that actually sources diverse candidates so we can actually have actions and solve that problem for companies looking for diversity.
David, you found companies do better when there's more women on the board.
There's clear data. It's diversity on the board. It's not just women. It's diverse points of view, different perspectives. And when you look at companies that have gone public over the course of the last few years with a diverse board, their performance outperforms those that go public without any diversity on their board. And so it's good governance. At this point, we should be even further along than we are, but we've tried in our small way to have an impact on moving the diversity of the governance process in public companies along by declaring that we would not take companies public unless there was diversity on their board. And we're going to grow that to 2 diverse candidates in 2021.
David, I'm sorry to ask you this. I'm going to be mad at myself tomorrow if I wake up and you guys have purchased the Wells Fargo asset management business. Are you guys involved in looking at that?
We're always looking at ways that we can invest to grow our franchise. You know that you're not going to get an answer to that question one way or another.
You know I have to ask it.
And you know that you shouldn't take my lack of answer, one way or the other. So we have 3 big platforms at Goldman Sachs: our corporate investment bank, our asset management business, and our consumer and wealth business. And we're going to continue both organically and, if the right opportunity came up, inorganically to try to grow them so we can serve our clients better. I
think I'm fresh out of time here. Thank you both, Stacey and David. This was fantastic. We could have gone another hour. I would like to go another hour. Let me introduce John Olajide to close the program. John, to
Thank you
you.
for having us.
Thank you. Thank you,
both.
Steve. Thank you, Steve. Really appreciate it. Thank you, David. Thank you, Stacey. That was a real treat. That could have gone on forever. Really appreciate it. Quickly, I just want to say thank you for all the nice comments about the Dallas region. The mission of the Dallas Regional Chamber is to make Dallas the best place to live, work, and do business for all people in the country. And David, thank you for recognizing just how special we are. Stacey, thank you for sharing that as well. Really, really appreciate it. As I listen to you guys speak, there are a few themes. We talked about COVID, and from your comments, some of the things that I took away from that, David, is that we should get comfortable being uncomfortable, and just lean into the change and embrace all that. And it's fascinating that given all the madness in our world, it's amazing how, as a society, we've managed to be resilient. And Stacey talked about all the ways we figured out a way to make it work. So we really appreciate that. Thanks for sharing your wisdom with us. On policy, you guys may not realize it, but you use the word balance a lot. And that's what voters have said as well. Hey, let's make sure we're not extreme. Let's figure out how to work together to make things work. And then I'm really excited that you talked about ESG and spent a lot of time talking about that. In the Dallas region, I'm known as the Mr. Business is a Force for Good. So David, thank you for your work on the Business Roundtable, just helping educate folks on the purpose of a corporation and saying, doing good is good business. So thank you for saying that. Stacey, you echoed that as well, and you shared with us that investors are paying attention to ESG. That may have been anecdotal from you, David, but we know the numbers speak volumes. And I'm sure as we investigate that some more, the numbers tell a story. There's a lot of innovation in the capital markets, as we talked about SPACs. And again, the message there is innovation is great. Let's embrace change. But I heard caution and again, balance. So thanks for sharing your thoughts with that with us on that. I'm a big proponent for diversity, equity, and inclusion. I just want you to know that we've done something very special in the Dallas region. At the Dallas Regional Chamber, we've created a board-level council on diversity, equity, and inclusion to make sure that we're focused on these issues every day. And in fact, one of our strategic pillars going forward for the next 3 years is diversity, equity, and inclusion. So we're leaving this out every day, and all the business leaders in our community take this very seriously, and they're working on it. So you're speaking our language. Thank you for joining us today. And we know this conversation would not have been possible without the support of our sponsors, including our presenting sponsor, Polsinelli. Really thank you for your sponsorship. Our gold sponsors, OCC. Our silver sponsor, Amaranth Bank. Thank you, thank you, thank you. BKD is our bronze sponsor. Thank you. Our VIP reception sponsor, Deloitte. We appreciate your sponsorship. And of course, Simmons Bank as well. Important news and resources as well as upcoming events are updated every day for you, your employees and colleagues. Visit our website. It's dallaschamber.org. Lots of great information there. Again, thank you for joining, and we hope to see you again in person soon. Stay safe, and we are adjourned. Thank you all.
Thank you.
Thank you.